Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host of the Smart Property Investment Show. Hope you're well. Tuning in on the Property Investment Podcast Network. Welcome. If you just found us, guess what? A hot tip, there's about 500 other podcasts you can tune into. So if you're dialing into this and it's a nice summer's day and you're sitting on the beach somewhere drinking fancy cocktails, which, by the way, the cost of living has really hammered recently. I'm not too happy with the state of things. Tune in, dial in. We pretty much covered off everything to do with property investment over many, many years. And I still get a big kick out of it. I was chatting with a young builder the other day, and he said, Phil, I just found your podcast. I went, oh, that's great. Sorry, you're probably sick of hearing me drone on about property. He goes, nah, man, I've gone crazy for it. I've told everyone about it. I want to start investing in it. Just a really good sage reminder for me of the reach and the influence of this particular podcast and many other good podcasts around property investment, really democratising property investment, making it more accessible for all Australians in many different guises. And the fact that guys like me who get the privilege of recording podcasting and having chats with investors right across Australia and those professionals who are as passionate as I am around helping people create wealth through property, it just reminds me it's a good thing to do. And I get excited about my Tuesdays, which is normally the times when I record these podcasts and I get to engage in these conversations. So if you're starting, get going. If you're at it, keep at it. And guess what? At some point in time in your property investing career, you'll probably start thinking about property a little bit differently other than the acquisition side of things. And that's very much where I'm going to steer the conversation today. I'm sort of going through it and the motions myself, and I've been discussing it at length on the Smart Property Investment Show about shuffling the decks is what I'm calling it, my portfolio personally, and also the portfolio I share with my business partner, moving into different asset classes. And guess what? It's okay to do, and many property investors do this at some point in time. I am conscious that we speak a lot about acquisition on this particular podcast. It's what people want to know: where to buy, how to buy it, when to buy it, what to buy, and everything connected in with it. But your journey through property, if you get into it early enough, should be a long one. Hot tip, the sooner you get into it, the better off you'll do. If you can get 4 decades of investing in property, aka you start when you're in your 20s and you invest until your 60s, you're probably going to do all right, I reckon. But you're going to have different cycles. There's going to be different cadence to how you choose to invest in property. And today's conversation, I think, will resonate with a lot of people, but it's above my pay grade. I'm just but a humble journalist trying to work out property investment. My job is to bring people into the studio that know a lot more than I do. One of them, unfortunately, is Paul Glossop, who's a regular guest on this podcast. I do lean on him personally sometimes just to get a sense check, another set of ears or another thoughts on any investment decisions I'm making. But he's also built a pretty decent business called Pure Property Investment, supporting Australians doing it. Paul, welcome back to the studio, mate. How you going?
Thanks for having me, mate. I'm well. It's a different take on what we're going to chat about and where it's going to go today. So I'm pretty excited on sort of taking it on as opposed to where and what to buy. It's probably more the evolution of a property investor.
Yeah, when do you buy at different times and how does it change? Now, personally, I get sick of the harassment and the bullying subsequent to any podcasts I do when I don't mention your book. So let's just get that out of the way quickly.
Surfer's Guide to Property Investment.
Have you got a version? Look at him. He's opening up his bag right now. And if you can see this on the internet, check it out. Bam. Is that the new one?
Oh, no, it's not. Oh, it's not.
No.
Look at that. Look at that. Bam. Right there.
There you go. When's the new one coming out? When's the new one coming out?
We talked about this a few months ago. I think it's going to be January. So we're going to miss the Christmas rush, but hopefully...
So how are you going to put in any Santa stockings?
I guess my benefit of this is that I'm not going to be starting, the bonfires over the Christmas period. I'm not going to be there the stocking stuffers and the Dimmicks sort of halfway bookshelves out on the
You're
back
not in the basement bucket bin.
No, exactly. Not in the bargain bin yet. So that'll be for 2024, no doubt. But, mate, it's coming out. It's about 3/4 through. It's time consuming.
So you're not enjoying the process?
No, I do, but it's just
I thought you'd be
time.
sitting in the country somewhere over the beach, sitting there on a typewriter, tapping it out, drinking a nice Pinot.
Snifter of brandy and all the rest of it. No, unfortunately, I've got to take your calls. I've got to take Alex's calls. That's my primary
That's
role.
your day job?
That's my day job.
Okay, good. All right, so it's in motion. But the point I wanted to make was that you actually probably talk about this thing I'm talking about in the book, this sort of mid-market investing.
I do.
And mid-market will mean different things to different people. If you start in your 20s and you've got 2 decades of investing in, you're probably going to be shuffling your decks and thinking about things differently. If you start in your 50s and you're on an accelerator program, you might only have 10, 15 years available for you to make and take action. So what do you call this middle bit of property investing?
So the probably the main component, and I do visit it a lot in the first book, Surface Guide to Property Investment, is it's the evolutionary investor. And I guess the mantra I take on that is that it's the evolution of man, the Cro-Magnon man that evolves to essentially full-flown walking, talking, and doing what we're doing in today. And over that time, you do different things at different times for different reasons. But essentially, it's always because most of the time, it's what you have the capacity and the means to do. The intention, and I guess what we're referring to today is that, to your point earlier, starting as soon as you possibly can is going to give you far more long-term ROI than waiting 5 years, waiting 7 years, waiting 10 years to get into where you eventually want to be. The steps that go into that are going to allow you to propel to get to a far bigger and longer trajectory. So the intention of the evolutionary investor, and that's sort of what I refer to this as, is that just because you started in a certain way doesn't mean you finish that way. It means that ideally it's going to get to a position, but at that position, and part of our job when we're speaking to our clients regularly is to review portfolios, figure out what the pivot is. Is there a different way that we need to go? Do we need the lower priced, higher cash flow assets? Have they served a purpose on growth, but maybe they're stifling that bigger investment? The ROI on holding 10 assets versus 3 good assets has to be questioned at particular points in time. And that's what we have to do regularly. And over time, what that means is that you do what you're doing, which is that you reshuffle the deck and figure out, do I have the right cards or do they need to be changed?
So 3 points I'll make just to summarise that bit, because I want to get into the meat of this. The first 2 points, when I asked property investors what they would do differently if they had their time again, they would have started earlier and they would have done more when they could have, right? The third point, what you're saying is that property is not a passive investment. And a lot of people get confused with this. They think, I'll buy all this property, sit down, do nothing. And then in 30 years' time, I'll sell it all and I'll be a bazillionaire. Property is not a passive investment.
Not at all.
We've spoken about it at length on the podcast. You can read all about it in Paul's book. There you go. There's another plug.
Nice one.
I need a little thing that goes bing, bing.
Little table knocker.
So it's not a passive investment. So let's talk about this middle bit. And I'm sort of going through the motions of this myself, which is really, really cool. I know you do it regularly because, it's about reviewing a portfolio. But we've got someone in the studio who's happy to talk about it. And the reason why he's happy to talk about it is because he's my business partner and he half owns this podcast and everything else that we do here. So we can hit him for lots of information. He's also a client of yours.
Correct.
Probably a good client,
Yeah.
bad client. Rate him. Let's start there. Alex Whitlock from Momentum Media. How you going?
Good, Phil.
So I know his portfolio. You know his portfolio.
Correct.
You've been on the show beforehand. You've shared your portfolio. Alex is an interesting investor in some ways.
In a lot of ways.
He's certainly not one of these I was going to do it type of guys, is he?
That's one thing I think Alex will be able to do very well on his deathbed is not look back and think, I should have tried that or I should have done this. I think you'll be well and truly at peace with yourself in what you could have and should have done.
Yeah.
You're not going to die wondering.
I've given it a crack.
I agree. And it certainly hasn't worked out badly by doing so.
So Alex is this sort of mid-level phase where he's shuffling the decks, thinking about his portfolio differently. We share half of the Smart Property Investment portfolio, and I've been chatting about it. We've sold off some assets recently. We're recycling that stuff, parking in other ways. But Alex has quite a large personal portfolio, and it's up to him how much information or how deep he wants to go into that. But you've been quite integral in the personal portfolio for Alex. That's right.
Yeah, absolutely. I think going back and sort of just as has rejigged a lot of my sort of notes and what we've discussed way back in the day, Alex, but I think when we first discussed where to and what to from where you were, it was essentially 8 years ago.
Yeah.
It's quite some time. We'd cast our minds back to essentially 2015, 2016, which was, at that time, I do recall you noted to me, and you shared with me a bit of your history there where you'd previously worked in Hong Kong, you'd had a property that you bought in, and I'm using memory banks, it could be inaccurate, but there was a property in Docklands, I think there might have been, or an apartment in Melbourne at the time, way back then, which has since gone. And it was more or less saying, hey, look, there's capacity, there's a starting, essentially seeding funds. Let's get busy and let's try to think about a 10-year plan to get towards some growth. Not necessarily cash flow per se, but growth, and let's get this portfolio exposed to the market.
Yeah, it's kind of not far off the mark. So started buying in, when I was in Hong Kong, I eventually bought 5 in South Bank in Melbourne. at different points. I won't bother running through sort of the individual prices and the individual sale prices, but sort of that. And then I bought an off-the-plan place in Manly, in Queensland, the suburb in Brizzy, and then reached a point where the pressure built to a point that could no longer be resisted to purchase my own home, which I was kind of as an avid property investor and believing all the hype, was quite happy to rent, but there are ideas outside of that in the family house. So cashed in most of my properties and bought a principal place of residence, which was good, right? You know, it was handy.
It was that doubled in value in a relatively short period of time as well.
We've funnily enough, we've actually only just sold it, Phil. It's the
that place,
CV Street, yeah. So a topic, to be discussed at length another time. But look, it was an important stage for me with my family, with my kids, with my wife. So it got us on that ladder. I retained one of the investment properties, and again, myself and Phil sort of set about building this business back in 2005. We did it on the smell of an oily rag. We gave up an awful lot. I won't, again, go through sort of, too much into that, but I sort of ran up a large credit card bill in order to be able for Phil and I to do the things we need to do in business, and then reached a point where myself and Phil reached a level of stability and income through running Momentum Media. So we both jointly went down the path of, and it's really the genesis of, the show that we're on now and Smart Property Investment. We decided that as to be commentators on to help guide investors to be legitimate in the marketplace and looking at all the nonsense that gets spouted by spruikers where they choose to ignore all the realities of property investment, the costs, the factoring in interest rate rise. We decide we're going to put our money where our mouth is if we're going to talk about this and provide, sort of advice to investors getting started. We're going to do it ourselves. So we started doing that. So we started I've rekindled my investment journey with Phil, and we still have a portfolio, which, Phil talks about in other shows. Running concurrent with that, and again, to your point, back in 2016, I decided, and Phil also decided to go down his own investment journey, and we've known each other a long, long time. And my goal at that stage was really to start building up some assets. It was really with a view to me paying off my mortgage at that time in 2016. And this is one of the really, really fascinating things that I love about life and about property, is that your strategy changes as you go along. So that was a starting point for me. I'm sort of looking at what at the time seemed like an extremely large mortgage. I bought a property on the North Shore, which was $1 million in 2012, which is an awful lot of money to me. And I was sort of, had I believe, sort of about a $600,000 mortgage, which I was sort of pretty concerned about. And I thought, well, I want to try and build some assets that can then have me being mortgage free. Of course, as time went on, then there was an evolution in that. So that's what got us started. And I can't remember whether we kicked off with the place in Hobart first. I think it probably was.
It was, I think at the time it was Kalanga and
was it Kalanga first?
Brighton.
Yeah,
so it was Hobart and North Brisbane at the time. Yeah, basically simultaneously.
Yeah. So and so that was again really about looking at the focal point for me in terms of doing that was about paying off and being mortgage free and taking the pressure off my family. Obviously, I work in a business with a very capable business partner, and we've fortunately been successful. But you don't ever really know. And myself and Phil are, sort of fairly conservative and fairly cautious. And so, it's a responsible way to move forward without putting full pressure on our business interest, to have a hedge to make sure that, should things not go as you would hope they would go, that I could at least be in a position, for my family to pay off my mortgage. So that was really about, that little sort of phase that you part of the journey with me and instrumental in your team in helping me, to go through, select various assets. So yeah, over to you. You know the drill from there.
Yeah, exactly. And I think at that time, mate, I mean, it's interesting when we sort of go back to what the intention was, and that intention has no doubt likely changed these days. I mean, it's not to say that that's still not an objective. Is to essentially you've upgraded family home and done certain things there, but I guess the sole focus of this property portfolio that you've built is not necessarily to say, well, I'm going to build it, sell it, and then pay off the home, because obviously we'll talk about how that's evolved and changed in different directions in that time. But I think that original stage was saying, okay, well, We've got borrowing capacity. We've got freed up equity. So let's get busy on building growth assets that aren't going to break the bank. Because I think one of the big objectives for yourself as well is we didn't want to just go all in on one larger, higher price asset, saying, look, I want to get some exposure to some markets, but still got to balance the books from a cash flow standpoint as well.
I just remembered, so what actually sparked this was after moving into that property, and the property went up quite nicely, in fact, because I bought right at the bottom of the market,
Yep.
and I saw some good growth in that property, and so, of course, in a heartbeat, I decided the best thing to do would be to refinance and buy a boat, which I went away and did, and then decided that I didn't want to have a boat anymore, and sold it. And so what that point in 2016 was, it was when I sold the boat, which I'd refinance, and I left the debt in my home, but I got a couple $100,000 or something like that. And so what we did was, rather than just sticking that money back into paying down my mortgage, I went, that was really the point where I went, okay, I can use this money now. I can either stick it back in my mortgage and reduce my repayments. Repayments weren't that high back then, or I can actually use it as an asset generating, asset building, appreciating vehicle to again. So then I went, oh well, I can start acquiring some properties. We kicked off with a couple and looking at really growing that portfolio. So yeah, that was
and that was the seed money.
That was it.
Boat
money. Don't buy a boat, folks.
Yeah.
Well, that led to something that you probably wouldn't have otherwise done if you're to be fair. You wouldn't have freed up the cash to actually buy it, then sell it. But that being said, I think we're looking through what we ended up acquiring in that relatively short period of time. I think it was about 1.5 years, 2 years.
Yep.
To utilise that circa 200K, I think we leveraged at a 90% plus LMI.
Well, before you go
costs.
there, Paul, I want to go to a break. And I will point out, it's not sponsored by Lululemon, by the way. You've been positioning that drink bottle all over the place. You're taking little sips out of it.
Is
Is that a paid partnership?
It will be on my socials.
By the way, it's gone nuts on the
absolutely. It's a more than $1 billion business.
Yeah, it's got absolutely
Canadian
nuts
business.
on the share market. Yeah.
That's no recommendation, folks. Dialing in, so we give you the disclaimer.
Don't buy anything.
Yeah,
Don't
you're
buy
buying
anything
the
Canadian.
Spruikers, they're all spruikers here.
Don't buy anything Canadian. Anyway, we'll go to a break. Everyone stay with us. Back in a moment. Welcome back, Phil Tarrant from the Smart Point Investment Show. I hope you're well. Joined in the studio by Paul Glossop and Alex Whitlock. They're chatting through what it would rate so far. You're sort of just probably 10% through this journey of property investing as a reasonably productive relationship, Paul.
Yeah, absolutely, mate. It's still the journey, to use the J word, is still certainly not close to being finished, but it's there's been some adventures.
So you got a mandate, a couple of $100 from the proceeds of a boat sale.
About $2 million in leverage that we had the capacity to, and then the intention there was to say, let's get busy and find some growth.
So what'd you do?
So we set off to figure out which markets were going to fit that criteria best back in 2016-ish, 17. I think when I look at the portfolio build and what we ended up building the portfolio in initially, we bought a freestanding house in Kalanga, larger block that had upside for a granny flat. That didn't get realised. It was just a buy and hold. It was about a 5.5% yield. There was a property in Brighton in Hobart. I think we paid sub 200 for that at the time.
215? Oh, maybe 215?
Yeah, somewhere around about that. And that was about an 8% yield. Again, buy and hold, nothing to do to that property. That was very early doors in Hobart. We were pretty active in that market at that time. We bought 2 side-by-side properties in Deception Bay. It was questionable at that time. Deception Bay definitely got question marks when we were buying there, but I'll tell you, if you look through the data in the last 5 or 6 years, probably one of the best performing Brisbane markets. Intention of those 2 side-by-sides was that they were zoned what was deemed to be high density. So whilst they were smaller blocks, we thought, okay, well, these are decent buy and holds. They're 2 separate titles with an
and to be fair, when we acquired those, it was with the caveat was it was a long-term view. You said that it's not speculative, but it's that there's a view with the zoning to develop, but it was never going to be, okay, we're going to start knocking them down and rebuilding them in 6 months' time. It was always very clear that this, is due to the zoning, that there would need to be other developments taking place before we would make that move. And it was always an option as an exit, should I decide to exit, that would be sold, with the potential as a development block.
Just dig into that for a moment. So you bought the potential, so 2 blocks side by side.
And another one in Mango Hill.
These are also just, for people not familiar with the Deception Bay market, these are small blocks. These are 405
square metres.
Yeah.
So the idea being that in time you could have done a development on it, and or if you wanted to offload it it would be an attractive proposition for someone else who would
you're
want to do
buying
a
some
development.
options there. You're buying. You could have probably stuck, I don't know, Paul's better position than me, but anything from 8 to maybe 16 units, jammed in. Ish,
Yeah, absolutely.
So that's an option for me / us to go into in terms of development, and then also you can obviously sell them as individual because they can be sold off as individual sort of properties, or you can sell it on to a developer looking to capitalise on maybe someone else has bought others along the street, or maybe someone in a similar position to myself and wants some options. So you've got a number of exits potentially. Or a retention. Like if you develop it, then you can either sell off your units
So
individually.
optionality is key. We've spoken about this before, Paul.
Yeah, absolutely. And the property in Mango Hill was the
Where's
last of
Mango
those
Hill?
five.
You're throwing out suburbs like people know where they are.
So Kalanga, Deception Bay, Mango Hill, all in the Moreton Bay Regional Council, North Brisbane. Deception Bay is pretty much on the bayside near the water, as the name obviously suggests. And then you go closer towards Petrie University. You're talking sort of anywhere between half an hour and 40 minutes from the Brisbane CBD. All three of those suburbs are on the train line as well.
The new train line that went
new
through
train
too.
line, access to the Sunshine Coast University Petrie campus, which opened after we bought those. There was a couple other big catalysts that sort of we saw that we thought were going to be good impetus for those markets to see above average capital growth. But I think to the point there is that all of those 4 properties in Brisbane, as well as the property in Hobart, they were universal properties. They were, hey, good growth assets, all freestanding established houses. Most of them had an upside. The upside might have been as simple as a granny flat, higher density development, something in between, but ultimately predominantly owner occupied, and we wanted that property to be incentivized for someone to rental the high demand on rent, minimal supply, and the ability to on-sell it to owner occupiers, investors, developers, and essentially as many people as we possibly can. And as a mantra for anyone listening, when you buy a property, and to your point, Alex, about what you've bought way back in the day, off the plan apartments and other properties that you sort of look at, the university, is that a word?
Universality.
It is now.
Doesn't sound very fluent off the tongue.
Universality.
Let's go with
Neck
that.
agility.
But I think for me, if I've learned anything over the years of buying thousands of properties and looking at the performance over that time, if a property is going to be attractive to more than one cohort, the reality is you've got more than one cohort of people looking at it. So ultimately, it's a supply and demand game. Property goes up if there's a lack of supply in an area where there's more demand. If you can buy property in there that's going to have the ability to sell to an owner-occupier, sell to an investor, sell to a developer, that's kind of the 3 main people you're always looking to attract to a property. Each of those 5 assets had all of that in spades.
And therein lies the simplicity with property investment. People try and overcomplicate it and make it sound as though it's like, this super duper, you need to be an actuarial boffin to get it right. It's not.
No.
Buy property where people want to live.
I think it kind of goes 2 ways, right? You either think it's really, really hard and complicated and you've got to be some sort of like super duper professional, or you think that anybody can do it and it's a piece of cake and you can just buy anywhere and you're going to make money. And I think that you can fall foul of both of those two positions.
Well said.
So this is still acquiring.
This is acquiring.
Property.
This was that first phase of acquiring property. So once those 5 properties were purchased, we kind of sat back for a little bit there from memory, and we sort of said, okay, well, let's push pause, consolidate, make sure the rents where they need to be, get your loan structures exactly where they were, and that's I think where you ended up sitting on the sidelines for the best part of a year and a half, 2 years, and let those properties play out. And to Phil's point earlier, about property being a passive investment. And I want to make sure that, and I try to be very transparent on this, none of those properties were perfect. They weren't terrible, but they certainly weren't perfect, and they weren't passive.
So it's worth sort of looking at the movement of property, right? And each suburb, each individual property doesn't move in a linear direction, right? They kind of ebb and flow and they bob around. And those markets weren't really moving anywhere. But there was never an expectation. I've been in the game long enough to know that I'm not expecting an immediate return. We've had that before. We maybe talk about some properties a bit later on. But though that market didn't really move, and it was a constant thing. And for many people listening, they'll probably may have some experience in those markets where it was like, when's Brisbane going to move? When's it going to move? When's it going to move? So they kind of sat there. They didn't go backwards. They didn't really. The rentals sort of crept up. I was quite happy with them, but they didn't really go. And the investment environment in general, around that time, APRA made a lot of changes to investment loans. It got pretty tough for investors. So there was never really any scope to kind of go anywhere. They just kind of sat there, but I was cool. I was quite happy with them sitting there. They were doing okay. They weren't costing me a lot of money. We were in an environment, dig back, where interest rates were on their way down. So holding property essentially got easier and got better. But, again, why were interest rates going down? Well, because, the economy wasn't going in the right direction, and because, that the market was fairly flat. So, that was the kind of the background through to, I don't think I made another purchase until 2019.
No, exactly, mate. And I think that was it. We sat on the sidelines. It was part intentionally, part by force, because you essentially spent the money you had available. You used the borrowing capacity you had available.
No more leverage in those because they hadn't really sort of grown.
Yeah, and then you let them be. And that's normal in property, right? Like, to see what's happened over the last 3 or 4 years for anyone who holds property in that time. Unfortunately, the expectation of seeing what's happened in the last 3 or 4 years, to expect to see that not necessarily in the next 3 to 4 years, but ever again in our lifetime, it may not ever happen. We might not see that level.
Isn't
of
it
boom.
the job of a buyer's agent to find those places that go up in value like that? That's what I get told.
I can assure you that there was no discussion about 25% average annualised capital growth to Alex when we bought those properties. And I guess,
so you got lucky?
No, we bought property with the intention to say we've got the 10-year horizon here. The objective at that time was to say in 10 years' time, ideally we take some of this cash off the table and pay off the mortgage. It was going in that direction. It was sort of circa 4 to 6% compounded annual growth with about a 5 to 6% gross rental yield, which was about cash flow neutral at the time. Yeah. It wasn't much more complicated than that.
And this is the point as people invest in property, as they become more comfortable and sophisticated with property investment, their horizon towards how they utilise property changes. And it sounds as though Alex's journey's had a number of different phases. The first phase, buying stuff with view to get into a family home, and then that family home elevating into more sophisticated sort of approach to investing. And then it sort of continues and goes on. And you must see it with all your clients over the years that it always changes, and change is okay.
Yep.
The best investors are the ones happy with change.
So this is, you're absolutely right. And this is why it's a fluid. For me personally, everyone's got their own different journey, and I'm wired a particular way. But again, get to sort of 2017, been in the, where I bought the principal place of residence back in 2012. The market in that area had gone up. Sort of our needs had changed. And of course, Phil, with the business, you kind of, we're quite cautious, we sort of felt, it's time maybe to kind of look at a more expensive property in a more convenient location. So moved across the other side of the Pacific Highway and moved into a new principal place of residence, which took up a large chunk, went in at 20%, which is, some people might think that's, you're quite highly leveraged there. For me, I try and leverage myself as much as I can. So bought in 2017, and then that took up, kept. I didn't get rid of any of the. Oh no, sold. We did sell.
Sold Brighton.
I think we sold Brighton in order to make that purchase. Yeah, exactly. So needed to free that money up for the for the additional mortgage, and then that kind of again sort of stopped everything for a while. Sort of got used to being in a more expensive sort of property with higher repayments, with a much bigger loan. And then, sort of a climb. And then 2019, and it was a really, really, really funny market back then. And it was probably, maybe, I don't know when you're due for your next break, Phil, but it's probably something to talk about in the next segment.
Due to the next break. So thanks for teeing it up, because we're getting into the third phase of this discussion. Stay with us, back in a moment. Welcome back, Phil Tarrant from Smart Property Investment, with Paul and Alex chatting through Alex's property investment journey, multiple different times of pivoting and changing. And it's an interesting question for you, Paul. A lot of people confuse objectives, strategy, and tactics. Please explain when it comes to property investment.
Oh, there you go. That's gone
quite
deep.
And the point being is that it sounds as though Alex's objectives have changed at different points. His strategies remain quite similar, but tactically it's evolved.
Certainly. And I'll go back into what Alex sort of brought up regarding selling to then rebuy in a second as well. But to your point, mate, we cover objectives as well as strategy, and then finally tactics, typically when we catch up with our clients in our very first conversation. Because
I thought you were going to say also do it in the book.
we do, but thank you for the plug.
No worries.
That is key, because I think ultimately most of the time when I do catch up with clients and we have either the first conversation or it could be the 15th conversation, we're 10 years down the track and we've bought multiple properties, in Alex's cases similar to this. The objectives might remain somewhat similar, where it might not be saying, hey, I need to pay down the family home, but it might be to say, look, ideally I want my property portfolio to fund my lifestyle at a point in time. Now, that's the objective. Now, the strategy is, okay, well, how do we execute on that? Is it buying X amount of assets with certain amount of capital growth as our target, in coupling with cash flow, with the ability to upgrade them, develop them at a granny flat, knock down, rebuild a duplex? There might be a corresponding different aspect of different strategies. The tactics essentially is what comes last. The tactic is here's what it is, here's what it looks like, here's the location, here's the why. But the tactics for us are always going to be, once the objectives are aligned, the strategy is then understood, we then go and execute on those exact tactics. And when it comes down to the order, that's the order that we typically would always follow as well, is that if the objectives change, then the strategy might have to change. The tactics certainly would change. And that's the part which we review very regularly. And inadvertently, we don't talk about that language, you and I, Alex, when we do talk about it necessarily.
There's too many tactics, strategies and objectives here for my liking.
But it does happen that way. It does happen.
Yeah.
Inadvertently, you do it that way.
But of course, so the genesis of this was really, I'm 56 years old now, going back sort of 2000. So we jumped to 2019, sort of 4 years ago. So, sort of reaching a stage where I'm sort of starting to think about life beyond work. So, not being a native of Australia, love the country, particularly love being near the water. So bearing in mind that I was still holding the 4 sort of North Brizzy properties. We'd sold off the Hobart property in order to help buy sort of a better family home.
And the reason why we sold that Hobart property, by the way, I think for the listeners, was that we bought that 2016. This was discussed sort of 2018, and we thought, well, we need to get some cash off the table.
And it had gone absolutely nuts.
It had gone bonkers. So to your point, Phil, is that we looked at it. Did the market do? Well, it actually did about 60% in 2 years.
Yeah, it was good.
It went berserk.
So that's twice you've done that.
Twice.
Hobart and okay.
Yeah.
So, this was now a matter of sort of thinking about, looking at retirement, not as in 2 years or 5 years, maybe not even in 10 years, but for me, the way that I'm wired, I can be very, very, very impulsive, but I've also got reasonable good scope for sort of longer term view. So I thought, I want to look at acquiring an asset that is going to give me a reasonable rental yield, but it is close to the water and somewhere where potentially myself and my wife could retire to, or at the very least, if I am successful in life, to have a weekender that we would want to go to. And I don't know if you remember, Paul, we first of all started looking at Manly. And I just couldn't afford to get into that market.
I do distinctly remember a property that we just couldn't get to from a financial perspective. It was on the water, the Bayside pool, the works. It would have done very well, but it was a stretch.
I just couldn't afford it. Just couldn't get there.
It was a perfect time.
So we pivot, right? And it's an interesting process to go through because there are a number of parties. There's obviously myself, there's my wife, and then there's you as the buyer's agent. So you go through this process of going, accepting that we can't really afford to buy in Manly. Look, we could have probably done it, but it would have been the expense of a great many other things. So we pivot, we readjust and we start to think about, what the objectives are. We're looking at retirement. So we reconfigured and we started looking at Mona Vale. And I was actually in the UK at the time and I spotted a property on realestate.com. I still spend a lot of time looking at property. I absolutely love it. And I saw this property that was up for auction, and I looked at where it was, and I had a look at the kind of the previous price guide, and it looked like it was something that was sort of going to be, sort of within the ballpark. And over to you. You did the negotiating on the property.
Yeah, absolutely. And that was a classic case because the timing in the market helps us, and it can help or can be a massive hindrance. And we're going through this now out live, Alex, where it's a help again, because 2 years ago, what we were negotiating now, I would have had absolutely no sway in the conversation or negotiation. But timing, 2019, property in Sydney, particularly blue chip property, wasn't exactly the way it was right now. It was certainly a tougher market. It was
very tough.
And ironically, it was pre-COVID, but there was a lot of other headwinds that were coming the way of the Sydney market in particular.
It was the absolute... We'd sort of, I've got a reasonable instinct for property, and we've been chatting over this at the 6 month, but I said, now's the time to buy something close to or on either the beach or the bay with a view of water. So we looked, as I say, looked at the Manly places. They were sort of about 1.8-ish, something in that region, and we just had to kind of, that just was beyond my capability. So This particular property was it's in Newport. There's a road and then there's the beach. It's got clear views of the water, and it just looked perfect, right? And, but they couldn't sell it. They'd taken it had gone for auction. It hadn't, so they had to abandon the auction because they couldn't sell it. It's just crazy to think about that property now. There's only 4 years ago.
And ultimately that's the type of property that if you're buying lifestyle properties, it's rare that you'll find them that for some reason they just don't sell. But at particular points in time, that was one of those points in time. So we obviously had all of the cards up our sleeve then, where we knew that the demand wasn't there, the pricing was probably wrong, the conditions that they wanted were incorrect, and that was our job, is that we went in there and figured out what the best way that we could get the deal done. We certainly shaved a fair bit off what the top line they wanted at the time was, but the beauty about you at the time as well, your finances were ready. You weren't there to dilly-dally. You weren't relying on X valuation or Y serviceability coming in that meant that it was all dubious, and then the price came in. I can't recall. It was in the early ones.
This is where I find it particularly interesting. See, I can spot a property. I know that it's the right place. Of course, I know how to weigh it up. I know the area, but I got the wherewithal. And I bought a lot of property. With yourself, I bought property on my own, but I had the wherewithal to give you a call, even though it was. And we looked at a couple of others in Mona. I went to an auction and we bailed on one. And I'd sort of been, I'd go do the hard yards, I'd go do the auctions. So for this particular one, even though everything looked good, I gave you a call. I think Lena may have done the actual transaction. But the bottom line is, so the property, you go and look at the data, it sold for 1.2 million in 2016. So I'm looking at it, I'm going, I wonder if I can get it for 1,250, or maybe we go as far as 1.3. That sounds like a reasonable price, but I don't know, right? Dealing with an agent. So this is why I called you and your team, and you guys bought that for less than it sold in 2016. It was actually 1.19. 10 grand cheaper than it sold. 3 years prior. So I would not have believed. I was sitting there, we'd have paid, if that had been me negotiating with an agent, I would have probably been happy with that. I'd have paid, 1.25, for that. So this is why I do use a buyer's agent. Even now, we probably ought to get onto the places that we've been buying more recently, because you do. It's the only way of knowing that you're going to get it for the best value possible.
Yeah, agreed, mate. And I think fast forwarding, I guess, from there, we sort of took a point where that property was purchased, but there wasn't really, there was a time, it was probably about a year after that, where the intention was still the same. Your financials were still available to say, hey, we can be opportunistic to look at potentially any other purchases that might come our way. And correct me if I'm wrong here, but that's where I knew of a particular property that was transacting well below what it should have sold for. And in my mind at the time, and this was a beauty about you and I having an ongoing dialogue about, hey, I'm ready to go if something does come up. It was a very spontaneous phone call.
Do you remember so I was sat with Munsrall, who many people will be familiar with, and Munsrall was saying, Alex, look, you ought to buy another property. I went, okay, hang on there, stopped him, phoned you up while I was talking to Munsrall. You went, funny you should say that, Alex. I've got a place right now, and within 5 minutes I said I'll buy it. Yep. It was that simple. It was off market. You were helping somebody who'd got some complications in their life and they needed to sell. And it was one of those situations where it becomes a win-win, right? Because they're looking to get out and they're in a sticky situation. You got a punter who's looking to buy, but it was literally that quick. It was a 5-minute decision, and then it was done.
To a contract being drafted up.
Yeah.
And it was a property in Engadine. Anyone familiar with the Sydney market knows it's a southern Sydney market, very owner-occupier centric. I have to go scratch my head. I think it was around 9:30. There you go, 9:25, 9:30. We paid for that property, freestanding house, 600 or 700 square metre block. Within 2 years, that property was revalued at about 1.5 million.
Yep.
Bank value and equity extracted at 1.5 million. Which subsequently that might be a property that we end up selling.
A little bit, the bank value was 1.5 plus.
Yeah, and that's the beauty about being finance ready and spontaneous. And I think after that was purchased, then we saw COVID run. Particularly Brisbane got the benefits of a lot of that run.
Yep.
And this is where you sort of made the decision to say, okay, look, I've probably made 10 years, 13 years worth of growth in Brisbane within probably 5 to 7 years. The opportunity now is do we decide to say, look, we might go after slightly more affluent and less property, less headaches, but take some of the wins off the table as well.
It's a difficult decision because the properties that I've looked to move into are inherently more risky in a very different way. You know, buying, let's say, blue chip. They're not really blue chip. You know, we're not talking, Rose Bay or but more blue chip than perhaps your Discovery Bays and so forth. So it's a different type of asset. So I bought a place. I think the next place after I bought was in Dunbogan, where I didn't use a buyer's agent, and I definitely paid too much. But that was a sort of an interesting scenario. But definitely bought a blue chip property there, and then moving on from there. So I started to build, and again, some background there. This is very much in this line of thought in my mind of looking now at generational properties, right? So looking at properties that myself, my family can enjoy, at some stage or other in retirement, looking at a real big gap in terms of cash flow. So the risk here is not necessarily, or not only in terms of whether the asset continues to grow or not, but it's really about being able to hold and fund and finance that. But again, being a little bit older, being, more stable in my business, being in those, once you're in your 50s, you're in your peak earning years. So I sort of went, well, I can probably sustain this, and manage this from a cash flow perspective. And then I'm buying a property, it's a lovely place. It's a place I love to spend time. And, you and I have been away many, many times. I like to imagine, going away with my friends and, go fish and surf and whatever else. So that was the kind of the mindset with that. So I'm taking, it's a shift in mindset, a shift in objective. You go through your own sort of risk return sort of evaluation. I look at, I rather than buying at 90%, with that, I was buying at less than 80%. So, if I have to take a haircut, it's not going to leave me destitute. If I need to sell, I'm not going to be, below a bank val and end up in a real mess. And then moving on from there, then there was a sort of a sequence really there of looking at, sort of acquiring properties that could be either lived in or enjoyed as more lifestyle properties with a good upside in terms of capital growth, but really taking a bit of a kicking in terms of cash flow. But again, that was the evolution in terms of sort of where I'm at. So look, those are the purchases which you weren't involved in, but I used a buyer's agent that specialised in that particular market, which I bought in Avalon, which I bought a 3-bedroom place in a perfect position looking out across Pittwater. And I got really the value of getting an outstanding view. It was a small property. It's quite sort of beach shacky type. It's 500 metres walk down to the water, but with stunning views down Pittwater. And, that was, so I'm sure people want to get some sort of sense of figures. So, the place in Dunbogan was 2.1 million 500,000. 2.1 million 50,000. The place in Avalon was 2.5 mil, and then sort of takes us on to kind of the next place that we're sort of looking at, which is a different type of asset. So obviously I'm still holding sort of the Newport 2-bedder. I am in the process of looking to sell that and there's a reason why, because it's a strata apartment. There's no dogs. We've got pets. I kind of got this view of looking at these assets with a view to an Airbnb scope, where when you become retired, semi-retired, where you don't want to be living there all the time, right? So you can generate an income through short-term lettings, and then you can go along when you're not working. You go there in the midweek and you can enjoy your property. That was never really going to be an option for the Newport property. So to give a bit of scope, we purchased it. Just under 1.2 million. It generates a rental return. It's actually a very, very good performing asset of sort of $950 a week in terms of rent. So really, really nice sort of cash flow property. It's had good capital appreciation. I am looking to sell that now. Look, it should be looking at about the 1.5 to 1.6 mark. So I'm looking to recycle that and then look at a different type of asset. And so I've got, I have the two sort of coastal places, one up, sort of 4 hours north near Port Macquarie, the other one, in Avalon Beach. And then the third asset I was looking really kind of in the city, and I took your advice in terms, we looked at a couple of different suburbs.
We did. We took a fair bit of time, and that was sort of really took us. And I think, again, to your point, is that the objectives of what Phil brought up earlier is that they definitely have shifted and evolved. And as everyone can probably hear, the property types and the locations are much more of a multi-use. Obviously, still with the objective of saying there's still got to be good quality assets, got to buy them at the right price with the right conditions. But then we sort of oscillated for inner city, both for family use, but also to say, is that something that you might use in the future, whether it's for a shorter period, longer period of time. And that eventually landed to Surrey Hills, which we've only very recently bought only literally in the last, well, it's still going through settlement at the moment, which didn't come without its fun and games on structures and also previous properties that we looked at and sort of just said no to. And I guess the funding component, you talk about the numbers on these properties, the Surrey Hills properties touch over 2 as well, 2 million. You can see that the prices of these properties has increased over time. But it goes back to what we fundamentally started with were very affordable properties, which perform very well, but probably didn't have the same purpose or need in your portfolio anymore and have since had to be sold to take the profit to utilise that, as well as the borrowing capacity to build towards other assets. The Engadine property, as we've discussed, potentially
still holding at the moment.
Yeah, that might also sell, take some of that profit, some of that borrowing capacity. You have no intention to ever use that property, and also, like you just said, with the Newport property, that'll likely be sold because again, it's not going to fit the future objectives and the mantra. But they've done their job.
So looking at the Surrey Hills place again, I want to give an insight into sort of the mindset. It's not just sort of a clean cut. This is a suburb where I think there's going to be good growth, but it's really about looking at, and I don't know how many people are familiar with, with the Sydney market. Surrey Hills sits just outside of, it's outside of Sydney proper. It's kind of one of your first suburbs that you kind of get to. It's an old, terraced, fairly gentrified suburb now, but it's got an earthiness and sort of authenticity around it that's kind of quite appealing. It's it's pretty safe, but it's got a kind of a good heart, but there's a lot of good places to eat and drink without it feeling, kind of too pretentious. So it's an appealing area to be in. So the thought process for me, looking both at this as a vehicle for investment and sort of capital appreciation, but also potentially somewhere further down the track again, so just throwing back to the other properties I bought, with the, the coastal place sort of a couple of hours up the road. You just, as you get older, you just don't know how you're going to want to be, right? I might want to be sat, out of the, sort of the heat of the city and be quite happy sitting, chilling out. But on the other hand, when you are older, and I just don't know, I might want to feel like you're a little bit a part of something, right? So the Surrey Hills property as somewhere to maybe, sort of have as a principal place of residence further down. It's a two-bedroom terrace, lovely, lovely property, small. I think it's about 90 square meters all up. So it's a small, compact, easy to manage kind of a property. It's not sort of absolute street front. It's a little bit of a yard, and it's on a quiet sort of on a quiet lane. There's rear entry, so you could kind of. It's somewhere which you could maybe see yourself living in if you want to live in that sort of close to city environment. On the other hand, as a renter, you're never going to struggle to rent it. So it's kind of hedging your bets. So it's a shift again. Where I'm at. I'm looking at a big gap. This is and with where we're at in interest rates right now, everyone who's purchased or thinking about purchasing will be very, very familiar with where we're at in terms of interest rates. Look, I don't have a crystal ball any more than anyone else, but maybe rates are going to go up one more time. Maybe they won't. We're kind of hopefully at the top of that cycle. Even if we're not, I feel that I can sustain it. You know what? It's tight. I can feel the repayments sort of tightening around my neck. But again, having done this now for 30 years, I've got the confidence to know that with the assets that I've got, with the tight cash flow, and I'm losing money, on an annual basis. It's costing me money to hold this portfolio, but I believe that the capital appreciation will outweigh that in the long term, and I can kind of sustain those losses. And I've also now got fewer assets, but so they're easier to manage, but assets which I see utility on a family level and probably on a generational level moving forward.
Optionality is what it's all about. That's the best sort of portfolios. No, great insights, gents. Thanks for coming in, Alex, and having a yarn. So you're about to settle on one.
About to settle on Surrey Hills. We're working secretly. I won't give away any details just in case anyone's going to be quick to listen to this and try to snap up another thing we're looking at, which again, same objectives.
Somewhere in Australia.
Somewhere in Sydney.
Maybe talk about, and maybe if we pull this one off, we'll maybe talk about that.
Somewhere on the water.
Okay, there you go. One thing Sydney has a lot of is waterfront properties. Yeah.
Just before we ran off, it seems churlish talking about properties of this, of this kind of value. And I have worked hard. I've scrimped for my first deposit. It's been a hard go, and even relatively speaking, now I have more income now, but I still sail reasonably close to the wind, but I always make sure I'm on the right side. I don't ever put myself and my family at risk in terms of what I'm investing in, but it's something which you can build up to, and I think your appetite for an understanding of risk gets greater as you go along, and you become more comfortable with I think you have a better judgment about what you're doing.
Yeah, and there is a huge cohort of investors like this. You just don't hear from them.
Yeah.
Normally you hear about people who are starting off
Correct.
in property. And if you are starting off in property, it's doing the hard yards is going to get you to a point when you can start thinking about having these sorts of conversations and changing what you're doing. So thanks, Alex, for coming in and give us an insight into it all.
Sorry, Phil. This is genuinely for me, though, Alex, and I probably never actually asked you this question. And Phil, you'd probably be similar entering this territory now. But just hearing this, you've been investing for a very long period of time, realistically. Yeah. And in that time, there's been a lot of different properties, a lot of different markets, and a lot of different reasons. My question to you, for my own benefit, was if you were starting again at Alex, age 25, age 30, age 35, knowing what you know now, knowing what you've bought, and we've just gone through. Literally, that could be a cross-section of half a dozen people's different portfolios all mashed into one. What would you do differently? If you had your chance over again?
What would I do differently?
I don't know. We've always heard the analogy of you'd buy more and
look,
essentially buy earlier.
I'm not going to torpedo any particular. I bought off the plan, without getting it. This is a subject for a whole new podcast, but I hadn't fully understood the cost of strata. You lose an awful lot of money in your investment in terms of, I looked at the price. I bought the first place, a one-bedder for $169,000 in South Bank, which, the capital growth on those things was phenomenal. The cash flow was really, really tight. And so it really hit and hurt me. I hadn't understood everything about, I was so focused on the property and the potential for growth. I didn't pay heed to the costs of management, of strata, of all the other supplementary costs. So look, I would probably do that differently. I'm not saying that that's not the right way to go. What I would say to people looking to start out on your journey, again, I think be courageous, but don't be reckless. I think you need to look at not just sort of what you're stumping up in terms of a deposit, but you need to look really carefully at the cash flow that's going to be generated. Are you paying, for additional strata stuff? Be really, really clear and cognizant on what you're doing. If you're taking a much older property, you're going to get hammered for like fences that get blown down, and you've got to really look about the holding costs and where your comfort sort of sits around that. You want to be, you've got to. I think anyone who goes into property, or many people who go into property, particularly younger people looking to start out, you want to be speculative, right? That's the fun, the excitement. I love it even now, but you've got to have a level of understanding what you're getting into. And I think with many things, you've got to see an exit, right? I think if you buy a property where there's no exit and things go awry, that's where you get your fingers burnt. I think you can afford to be courageous. And we go back to Paul, like some of those assets that I bought. Well, look, even the off-the-plan place, they were always going to sell. They're so close to Melbourne city centre. They were always going to sell. And I sold one of them at a loss, and I sold 4 of them at a profit. So look, every now and again things happen. You got to get out. And I've sold subsequent properties. I sold the one in Batinia. I took a haircut on that. It was painful, but that's the way it goes. It was it was needed to be done in terms of my overall strategy. But at the end of the day, there was a buyer to take it off. I didn't lose money per se, but in terms of the costs, I lost my stamp duty. Mm-hmm. That hurt. So I think be courageous, but make sure that when you're starting out, there's got to be an exit. Don't buy a dead-end property where you may end up getting saddled.
Exit strategies, page 202 of a Surface Guide to Property Investment.
Is that right?
That's it. Exit strategies.
I'll have some royalties on that.
Yeah, absolutely, mate. You can take half of my 15 cents per copy. No problem.
On the first copy sold.
Thank you to my publisher, Major Street Publishing.
There you go. All right. Well, thank you. Very insightful. I'll conclude with this remark. Why does it hurt so much more to lose money on property? But when you look at your share portfolio and it's down, you just laugh at it and just go. It's because you can't. The only decision you can make is whether to buy that share.
It's got to hurt though. But you can't be afraid to have a haircut every now and again. I've made money, and there's been a couple of properties where I've lost money, and it's a bloody nose. But the thing is, you've got to look at the whole picture. You can't have a win every single time. No. You can't buy at the bottom of the market and sell at the top.
But you can't get a win all the time, right? I looked at my share portfolio this morning.
Oh, mate, don't.
And there's about 20 different stocks in there. Only one of them was green.
Oh, the worst stock
And I
picker.
just laughed at it. I just went, what do I
And
even
that's
say?
the point, the emotion. You just like, you literally laugh at it. Could you imagine that was a message from your property manager saying, "Oh, your hot water heater's blown up"? The difference in what your frustration would be. You'd be swearing at your phone. Yeah, steam out your ears. The worst.
It's a lot, yeah. Anyway, thanks for tuning in, everyone, to the Smart Property Investment Show, part of the Property Investment Podcast Network. Remember, check out smartpropertyinvestment.com.au. If you like what we're doing, please keep those reviews coming. We get a kick out of them. It's just not us, particularly me behind the mic. There's a big team here that make this podcast as good as what it is, and they get a lot of satisfaction seeing those positive reviews. Thanks for tuning in. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.